Good evening. Welcome to our session. The buck stops with you taking control of your financial future. I'm Valerie Flannery. I am the current chair of the Women in Otolaryngology section for the Academy of Otolaryngology Head and Neck Surgery. And I'm here to start our presentation off. We have this session is part of our year-long concentration on women becoming our own wealth managers. And through some support from Sarah Hollingsworth from C2DX, we have the opportunity to speak with and share some insights from Peggy Corsillo, who is from Raymond James. I will turn it over then to Sarah.
Wonderful. Thank you, Dr. Flannery. I'm Sarah Hollingsworth. I'm the Vice President of Marketing at now the newly rebranded Everest. So we were formerly known as C2DX, but many of you actually likely know us from historical Cook product lines, Cook Medical, otolaryngology product lines like biodesign, cell endoscopy, and some T&E balloons. We acquire, invest in, and revitalize often underserved medical products. And this partnership with WIO has been a big part of our commitment to supporting surgeons and the patients that they serve. So I'm extremely grateful to be here and to be a part of it. This topic actually came up about a year ago with Dr. Flannery and I and a group of other women over lunch at COSM, and we are thrilled to now have finally found Peggy Corsillo here to be able to lead us in our first session. So Peggy is a wealth manager at Raymond James Financial Services, a graduate of the College of William and Mary. She has over 30 years of experience working with institutional and high net worth clients. Peggy spent much of her early career working in institutional investment management, including as an equity analyst on the Morningstar 5-star rated First Eagle Fund of America. She later founded and ran her own investment advisory firm, Core Capital, before joining Raymond James in 2023, where she's a wealth manager working with a select group of clients, majority of which are women. Peggy is passionate about educating people on investing. She's spoken on topics ranging from paying for college to women and investing, and is looking forward to sharing her insights with you today. So with that, Peggy, thank you for leading us. The floor is yours.
Thank you for having me. It's a pleasure to be here and to speak about something that is near and dear to my heart, that I'm passionate about, which is exactly your topic. It's women not only as wealth builders, but as their own wealth managers. And we'll go through, why this is so important. And I hope that it's helpful and empowering to all of you who are on various, paths along your financial journey. So with that, I'm going to jump right in. And I'm hoping, there we go. 61% of women would rather talk about their own death than money. 64% of women would like to live to be 100 years old, yet 60% of women fear that they will run out of money before they die. 90% of women are confident in paying bills, 84% in budgeting, 76% in choosing insurance. But when it comes to investing, only 1/3 to 1/2 of women are competent compared to 2/3 of men. 41% of women say their biggest financial regret is not investing more. And incredibly, 90% of women will be the sole financial decision maker at some point in their lives. The buck is going to stop with you. Are you ready? We've all heard about the earnings gap, but that's just the start. 42% of women aged 18 to 64 years old have bachelor's degrees, yet women hold 64% of all student debt. Then, when they enter the workforce, they earn only about 80% of what a man does. 80% of women are mothers, and many take time off to parent. Later in life, 2/3 of elder care is provided by women. 77% of widowed people are women. By age 85, women outnumber men by 2 to 1. Without a spouse to help take care of us later in our lives, we wind up spending a lot more on professional care, as much as $200,000 more. So we take on more student debt. We don't earn as much as men. We take career breaks, retire earlier, and on average, live longer. spending 7 more years in retirement while incurring more medical and end-of-life costs. So what does all this add up to? If a woman has taken time off during her career, she would likely have earned over $1 million less than a man who stayed continuously employed. The typical retirement cost is $738,000, yet only 9% of American women have $300,000 or more saved. The average single woman has 3 times less wealth than the average single man, even when adjusting for similar levels of education and age. What we have is a wealth gap. According to surveys, 7 in 10 women wish they had started investing earlier. 84% of women say investing their finances is key to career flexibility, and I would add other flexibility as well. 3/4 of widows and divorcees wish they had been more involved in financial planning. And unfortunately, 74% of widows and divorcees report discovering a negative financial surprise after divorce or the death of their spouse. The worst time to try to figure out your finances is in the throes of a divorce or when you're grieving the loss of your spouse. Yet that's exactly what many of us are doing. We're focused on taking care of our physical, mental, and spiritual health. It's time to take care of our financial health. Let's talk about some good news. We've come a long way. Today, women make up nearly 60% of college students and graduates. There's been a dramatic increase in women's earnings, growing by 75% from 1970 to 2015. Of women who do invest, 77% report feeling they will be able to save enough to last them for the rest of their lives. A 2022 study showed that women are increasingly confident in both managing their money and their investments. Women control an estimated $10 trillion of wealth in the United States today, with estimates that they will control $30 trillion by the year 2030. That's in 5 years. Ironically, women are better investors. A 2021 Fidelity Investments analysis of over 5 million customer accounts showed that women outperformed men by 0.4% per year. While it doesn't sound like a lot, when you compound that over time, it adds up. Yet another study by the Warwick Business School in the UK showed an even bigger gap, with women outperforming men by on average 1.8% per year, while trading about 30% less and less likely to take on risk. Lastly, a 2010 to 2020 Wells Fargo study also showed that women-led investment accounts earned the highest absolute returns and the highest risk-adjusted returns. These studies have shown that women tend to have a more disciplined approach to investing, and they're more willing to learn, seeking out education and advice from investment professionals. So why aren't more of us involved with investing? I get it, we're busy, but just this is not something that you can procrastinate on or delegate to a spouse or someone else. It's too important, it's too costly. Remember, you likely have 7 more years of retirement to fund with likely less money. And 90% of us will be making all of those decisions at some point in our life. And you don't want to wait until it's when your brain or your emotions are not working as well as they're working today. You need to be involved now. So with that, let's start closing the confidence gap. Let's go over some key concepts to help you feel more empowered and more ready to do this yourself. Why does investing matter so much? 2 words: compound growth. Saving is only half the battle. You need to invest to grow your money. For years now, inflation just has not been something we've had to worry about until more recently. All of a sudden, everything is more expensive. If you are not earning a return over the rate of inflation, you're falling behind. The dollars you save today will actually decline in purchasing power if you're not keeping up with and beating inflation. So how are you going to do that? Compound growth is powerful. At 7% per year, your money doubles every 10 years. If you invest $100,000 now in 10 years, at 7%, you would have $200,000. Give it another 10 years and you have $400,000. 10 more years and you're at $800,000. And in 40 years, which is maybe the average life of a career, you would have $1.6 million. Now we're talking. But you need to invest appropriately to get that 7%. While stocks are more volatile than bonds and cash, certainly, they offer higher returns over time. So that is what this chart is showing. Looking at it, we can see that stocks, the dark blue line on top and the light blue line below it, that small cap and large cap stock, have compounded since 1926, so just about 100 years, at between 10 and 12% per year. Bonds, as represented by the orange line, have compounded at about 5% per year. Treasury bills, which are pretty much equivalent to cash, at about 3.3%, with inflation averaging almost 3%. So cash or treasury bills just barely earning you above the rate of inflation. While there is more volatility to stocks, so that would be the wiggles in the line, essentially, that you see, they give you substantially more return over the long term. A Fidelity investment study showed that women tend to be too conservative in their asset allocation, leading to smaller nest eggs. You need an age and risk appropriate mix of both stocks and some bonds, as well as possibly other asset classes, which can outpace inflation and earn you a positive real or inflation adjusted rate of return. If you are young, congratulations on being here and taking agency in your future. Saving and investing early and often will serve you well. There are a lot of numbers on this chart, but if you just kind of focus on the lines and don't get too wrapped up in the numbers, what you see here is that if you start saving at 25 years of age and save continuously for 40 years, until 65 years of age, you would have saved $96,000 or put away $96,000. And if you earn just a little over that 7% per year, you would have well over $500,000 saved. If you start just 10 years later, that is the purple line that starts at 35 on the bottom. Highlight it here for you. Here, you have substantially less, about half. If you start early but end early, you're obviously not going to save a lot of money and you're not going to get that power of compounding. So again, use the power of compounding to help you. Start saving early, stay invested. This is another chart that demonstrates the same concept, essentially. If you are 25 years old, and if you save about 10% of your income, no matter your income level, and you continue to save, in this case, the example is until, again, you're 65 years old, and some assumptions on the investment returns, you should be able to maintain that same standard of living in retirement. However, if you wait until you're 45 or 50 years old, you can see that you would need to save substantially more of your income, 30 to as much as 45%, in order to be able to maintain that same standard of living at retirement. Maybe the most misunderstood concept is risk. Risk is not inherently bad. Risk is simply the uncertainty of an outcome, good or bad. Without risk, there really is no reward. Volatility or fluctuations in the price or value of your investments over time is not even necessarily risk if your time horizon is appropriate. Not keeping up with inflation is risk. Permanent loss of capital is also risk, so please invest, don't speculate. Studies show that women tend to invest more conservatively. More than 60% of women are willing to take little to no risk, and that's compared to about 45% of men. Again, without risk, there's just not enough return. So remember, not keeping up with inflation or your future needs is risk in itself. So take the appropriate risk in your time horizon. Again, while the stock market can be volatile, it's one of the best places for your money to grow over time. Even after large declines, it recovers and grows. Sometimes the volatility is to the upside. In fact, if you bought on all of the worst days in the market, your returns would be better. And that's because often the worst days are followed almost directly by the best days. This chart showing some of the worst declines are the best times to buy, when you can expect very strong returns. There are some large drawdowns in this chart, and some far larger increases over time for those who stick with it. So as an example, maybe some people remember the great financial crisis in 08-09. Market was down 57% and then went on to be the biggest bull market of all time, 401% return until we hit COVID. We had a rapid decline of 34%, and then up another 114% in 2 years' time. So just a demonstration that over time, the returns by staying in the market are the best that you're really going to get. Time really does heal all wounds. This chart shows up years, the green bars, versus down years, the purple bars. And what you can see is in 1 year time periods, yes, there are down years, obviously, in the market. But as we move to 5 year, these are rolling returns, you can see far less of those purple lines, and 87% of the time, the market was positive. When you move to a 15-year rolling time period, 100% of the time, the returns were positive. So yet another depiction of this is going to show you that even within a year, you can have a down, dramatically, in some cases, down market, and yet close the year up. If anybody remembers the crash of 1987, that's shown right here, we were down 34% in that year. We closed up 2%. Back in 2009, we were down 28% at one point and closed up 23%. That's a turnaround of almost 60% in 1 year. More recently, in just the last couple of years, we've had some very strong returns, despite having double-digit corrections during the year. So corrections are a normal, healthy part of investing. Don't be afraid of them. In fact, take advantage of them. Lastly, on this topic, this chart shows that while both stock and bond returns can be volatile in the short term, so here we have 1 year returns, and this is the range of returns in green is stocks, in blue is bonds, gray would be a combination of the two. Generally, the 60% stock, 40% bond is a pretty traditional, balanced portfolio. But as you move to the right, you see again, 5 year rolling periods, those ranges get much narrower, and the returns are almost always positive. When you get to 10-year rolling returns, even narrower and virtually always positive, and in 20-year rolling returns, always positive, with a much narrower range of outcome. So volatility is not fun, but it's part of investing, and hopefully this gives you some confidence that it's just part of the process and that is absolutely worth enduring. Because risk differs for different investments, you need to diversify your portfolio. There are different asset classes or simply types of investments like stocks and bonds, and even within stocks and bonds, different types of those. There's large cap stocks, there's small cap stocks, US, foreign, emerging markets. Within bonds, you have government bonds, municipal bonds, corporate bonds, and even high yield or junk bonds. And there are several other asset classes: gold, commodities, real estate, crypto, is even alternative assets, etc. While some asset classes have more risk and volatility, they should give you more return over time. They also have different drivers of those risks and returns, which causes them to perform differently under different scenarios, different circumstances, and different times. Some of the drivers may be more economic, some more geopolitical, some could have demographic drivers like the aging of the population, or even thematic drivers like artificial intelligence. In any 1 year, and lately it seems in any one day, certainly week, the returns for any of these asset classes can vary dramatically. So you need to have your eggs in different baskets. And this quilt chart is depicting that. There's a lot of colors on here, each representing a different asset class. And some will bounce around more than others, like small cap stocks in orange. If you remember back to the other chart, higher returns than large cap stocks, but more variability in the return. And really, that is kind of the message from this chart, and that also that this white asset allocation, which would be a mix of these asset classes, tends towards the middle. So again, diversification is going to smooth out where some asset classes performing better, some might be performing worse, but you don't know when they're going to turn around and become the better performing asset class. So having the mix is what you need. Another thing to think about with this, number one, is you need to think about your mix, and that is your asset allocation, or work with a financial advisor who can help you walk through what a good asset allocation is for you based on your circumstances, your age, your goals, what you have going on. Generally, the younger you are, the more risk you can and should take, but everybody is different. This leads us to talking about the last thing I wanted to talk about, which is time in the market, not time ing the market. This may be one of the most important concepts. This chart shows that if an investor over the last 20 years, ending at the end of 2024, had remained invested in the market the entire time, fully invested, they would have averaged 10.4% return per year. Being out of the market on just the 10 best days, which again often follow those worst days, and you would nearly cut your return in half to 6%. Missing the 20 best days, almost cut in half again to 3.5%. And missing the 30 best days, 20 years of investing, and you would barely have a return. Missing the 40 best days, and you would have gone negative. So timing the market is hard. Don't try it. Let's face it, we're human, we are emotional, and overcoming those emotions so we're not panicking out of the market at the bottom or chasing returns at when the market has run is really hard to do. Stay focused on the long term, stay disciplined, and stay invested, even when it's scary. And again, even investing at some of the scariest times, we have the Great Depression, World War II, Black Monday in 1987, if anybody remembers that, the bursting of the tech boom in 99, 2000, the global financial crisis when we didn't know if we had a financial system, COVID, when we didn't know what was going to happen to all of us. Even in all those times, your returns are going to be positive if you stay in the market. This is a log scale chart. This is enormous return on your investment. So this kind of leads me to my last point. All the press about professionals not being able to beat the markets. A 2019 Vanguard study showed that financial advisors can add as much as 3% to your returns. That is huge. Remember, if you compound at 7% per year, your money doubles every 10 years. If you compound at 10% per year, your money doubles every 7 years. So if you remember that $100,000 that we invested back earlier in this conversation, that over 40 years compounded to $1.6 million. Do you know how much that would be if you had compounded at 10% instead of the 7%? $4.5 million. The power of compounding is incredible. I'm not asking you to take on inappropriate risk, but don't be overly conservative and don't panic out of the market at the bottom. A good advisor can help you do many things. They can help you think through your financial goals. They can get you organized, saving and investing, what types of accounts you should be opening, what types of assets you should be investing in. They can give you an appropriate asset allocation. They can help you with other things if you're thinking of saving to buy a house, if you're leasing or buying a car, saving for college is a big one. Making sure your assets are titled appropriately is very important. Making sure you have your wills, powers of attorney, estate planning documents all in place. And they can add a lot of value by saving you taxes while you are saving and investing. And in retirement, when you are taking the money out to find the best, most tax efficient ways to be doing that. They can help you with charitable giving strategies or with intentional investing in line with your values. They can empower you in so many ways, but maybe most of all, they can keep you invested, again, even at some of the scariest times. So I hope this is helpful. I hope it's motivating and empowering and helps you no matter where you are in your financial journey. I know it can be overwhelming in our busy lives, but it's so important. If you have an advisor and you haven't been that involved, start going to meetings, start asking questions. There are no dumb questions. If somebody makes you feel like you're asking dumb questions, find a new advisor. If you don't have one, start learning, go online, talk to people, ask people for recommendations. When you're young, save at least 10% of your earnings. If you are older and catching up, go back to that chart perhaps and start saving a little bit more. Don't put it off, before you have this other big expense. Bake it into your budget. Fix yourself now. So a few things, again, save early and often, let compounding work for you, invest appropriately for your risk tolerance and your time horizon, stay invested, stay focused on the long term, have emergency savings and appropriate liquidity so that it helps you ride out those markets. You know you're okay, you don't need to take that money out. And just a couple of other thoughts to leave you with. Your only sure investment is an investment in yourself. And I love that quote. And I'm talking to a bunch of women who've invested in medical school. So I think it should ring true. And one last one is if you don't control your money, it controls you. So thank you. And I'm happy to answer any questions.
Thank you, Peggy. That was great. I think even in my older age and being in practice for a long time, I've still learned a lot from this. I would like to start with one question for you. So in medicine, we start as students, we get a lot of debt built up, and then our prime wage earning may not start till over 35. And you don't have a job, so you don't have money to start investing when you're 20. What sort of tips do you have for our students or young residents before they go into practice? How do you start saving and sort of manage that when you then have more of your big expenses coming? You have to pay back your loans, you have to buy a house, and you have your kids, and then 20 years later you're thinking about college. How do you advise them to manage that?
Well, the short answer would be that's okay, and that's totally understandable. You're just going to have to start saving more if you're starting to save later. But I think one thing that I would add to that is maybe, and this is a big question, student debt. Whether it's medical school, and I know that's worse. But student debt's a big problem in the country, and it can be expensive. And what do you do first? Do you pay off your debt? Sort of what you do. I think that it's the answer might be different for everybody. It's just a little bit a part of your personality. But one thing I like to think about is starting to exercise that muscle. So if you are saving $100 a month, whatever it is that you can sort of eke out, even if maybe it means paying a tiny bit less off on your loans or something like that, maybe just get going so that, again, you're in the habit and you're exercising that muscle. And for most people, I tell them, try to automate things. So it's coming right off the top. You pretty quickly forget you ever had that money. And so it makes it easier to save that money and then save it, but don't forget to invest it. So if you're working in a hospital and you're in like a 403B plan or whatever the retirement plan is, at work, have that taken out of your paycheck, but make sure you've made the choices to get that investing. And when you're younger, you want those choices probably to be all stocks, right? So that you're getting, that's what, again, you have so much time to recover in the markets, and that's where you want to be. But I think maybe you think about it in some buckets so that you're making progress in different aspects. You're making progress against your debt, making progress, saving for a down payment, and those kinds of, you're making progress if you have young kids, saving towards their education, maybe doing a little of everything. It's a little bit a matter of going to focus on paying down that high cost debt first. If I have some lower cost debt, maybe I let that ride and try to save even just to, it may not make mathematical sense, but again, it's exercising that muscle and getting you in that habit.
We have a couple from participants. First one, are annuities and whole life insurance policies good investments?
So I am not, they're both insurance investments, and I am not insurance licensed. What I will say about them is they often have very high fees. So you're starting off investing with like 95 cents on the dollar or less. So you're starting behind, and you've got to, the way math works, right? This is just an easy example. If you lost 50%, to get back to even, you have to gain 100%. So starting down is kind of a difficult place to start in the hole. That said, there can be some tax saving strategies with that. There can be some instances where, for example, annuities, there are some people that if you are so fear-based, honestly, you just may need that. You may be willing to pay that price to get that security. But I would say be very, very careful to really, really think through those investments and don't be pressured into them, and maybe get a few different opinions and a few different options, annuities, life insurance, or not. What are some other options, and compare them. Don't jump into them, because as I say, they can be really expensive. They can be very complicated. You need to read the fine print.
That's great. Thank you.
Mm-hmm.
Another one. At what net worth do you recommend seeking a financial advisor?
So different financial advisors will have different potentially minimums that they may have, to require you to be a client. All that said, often their minimums may be lower for somebody who's a high earner who's going to start socking away a lot of money because they know you'll get there faster. So I think a little bit's going to depend. Sometimes you don't have a lot of money. Mostly it's in your retirement plans. That's where most of your saving is starting. Although I would encourage you to have some liquid assets, not to sock it all 100% away in the retirement plans, and have some available. But I would say, when you get to a couple $100,000, you should be able to find somebody who can work with you, and maybe sooner.
Great. Thank you. Next one, for those closer to retiring in their 60s, is it good to have 60% in bonds and 40% in stocks?
Again, it's going to be a little bit personal. Right now, with bonds, you can earn approaching 5%. For years, we were earning almost nothing. So I would have said, you're just not going to get there fast enough. That sounds like a bit, for me, of a conservative. I don't know where exactly you are in your 60s and how close to retirement you are. Obviously, the closer to retirement, probably the more conservative you're going to be. But what you have to remember is, even if you're closer to retirement, but you're only in your young 60s, you may be funding 30 years of life, right? You have to kind of think about that. And so you still need growth assets in that asset allocation. So you may just want to have a couple of years worth in your bonds. So again, that the stock market will do what it may, but as you're starting to take money out of those accounts, you're okay. You're taking from bonds, you're not taking from stocks when the market's down. But you may want 25 years of growth assets in there. So 60% bonds sounds conservative to me. Everybody's different. Another thing to think about in general is, if you told me you had, I don't know, more money than you'll ever need, then I'd say, what the heck, be conservative. Why do you need to take on risk? But if that's not the case, then you need those growth assets.
And that again, oh, go ahead.
Go ahead. I was going to say, things are so personal, to your circumstances and your risk appetite, et cetera.
Sarah, did you have another question, or I can ask a question?
No, I thought.
No, when we're thinking about 60s, and that was from Sherry Ann, and I said I would actually mention too. She is one of our candidates for president for the academy this weekend. They're having a discussion, so um, everyone on the call who's academy should tune into that so we can hear their talk about our future. But speaking of future, I was thinking about I'm early 60s, retirement in the horizon. And I still think about gifting for my kids. And a lot of people, especially in the media, talk about giving their kids money before they actually retire and not leaving it for, after they've died. How do you think, um, or what should be help determine if you should give some money to your kids? Is there any sort of formula for deciding how much of your income or how much of your investments you should give, and how early you should give it to them?
Again, it's going to depend on how much you have and how much you think might be you can afford to give them, honestly. From a tax standpoint, you can give them $18,000 per person per year. So if you were married, Valerie, I don't know, you and your spouse could give each of your children, and if you wanted to give your child, and if they had a spouse, you could each give them each $18,000. So it can add up, and that is again, without gift taxes. If you wanted to give more, you can. You just eat into your unified estate exemption, which right now is up to approaching $14 million per person. So again, if you're married, that's going to add up to about $28 million. So if you don't think you're going to go above that, then you could give more, and it would just work that down for later in your life. Now, that can change. That 14 million is actually part of the 2017 Tax Cuts Act and is supposed to sunset at the end of 2025. Is highly expected to be extended, but we don't know yet until Congress gets around to passing that. There's a lot of different answers to that. For some people, they may worry about their kids squandering it. For some people, they may think this is a great test or practice, that kind of thing. For people who worry about potentially it being squandered, or for some reason want to put some kinds of limitations on it, you can form trusts where you can remain the trustee. It would be a living revocable trust, which means you could revoke it at some point. So it's pretty a simple trust to form. It wouldn't take a lot in terms of legal work and tax. It's under your tax ID and that kind of thing. So that's another option. Again, it kind of can be so personalized based on what you're trying to accomplish, what your wealth is, your circumstances are, all of those things. But yeah, for a lot of people, and they feel pretty confident, they have a good financial plan, that they can afford to give it away, enjoy giving it away now. Enjoy seeing that. Maybe it's going on a family vacation. Maybe it's funding grandkids' private school or college education. There's 529 accounts that are great for that. Or maybe it's just, helping out your kids because it's expensive to be, especially if they're raising kids and depending on where they're living and all of that.
Great, thank you.
Thank you.
A couple more. How do you advise people on what % of their savings to invest pre-tax, 401k versus post-tax? My employer allows a large amount per year to be put into a Roth account. Hard to know when our tax rates will be better now or in retirement, so we struggle with how to divide the investment.
Yeah. Again, I don't know the age of the person asking that question. For young people, it is Roth all the way. Because generally, now this is going to be a little bit different for this group, but generally when you're, first of all, Roth in a retirement plan is new and there are no income limitations on that. And that is great. For most of our lives, it's been a Roth had income limitations. And so when you were young was maybe often the only time you could save in a Roth, you were going to max out and not be able to save. For people who don't know, Roth contributions are not tax deductible now, they grow tax-free, it comes out tax-free. As opposed to a traditional IRA where you would get, or putting it into a traditional 401k, you would get the tax deduction now. But remember that, let's say it's $100,000, you may be getting a tax deduction on that. And 30 years later, you're taking that out and you're paying taxes on now $800,000. And so it depends on the person. I know that's not the most satisfactory answer, but it really does depend on that and your circumstances, as you know, working out a balance of what you need now. You're going to be probably higher earners now and liking that tax deduction now, but paying those taxes now may benefit you in the future. If you just look at the federal deficit and debt, you probably are going to bet that tax rates in general aren't coming down. Our current administration is saying that they're going to try to bring them down, but I don't think that's sustainable for a long period of time. Again, it depends a little bit on when you're looking at retiring, but retirement can be many, many years. And I wouldn't count on tax rates being lower. So that would have you lean towards the Roth. As far as what you should just save in taxable accounts, again, make sure you've got emergency savings. A year or two. I mean, doctors are less likely to lose their job. That's, going to be more for somebody in a different profession. But, things come up, whether it's medical, whether I don't know, you need a new roof on the house or you need to help out a parent or a child or something like that. Things come up. So make sure you've got some money that is accessible. Max out as much as you can on the retirement. Absolutely get the match. When there's a match, max that out because that is free money. Often the difference between that 7% and 10% is the match in your retirement plan. That's often 3%. So it can make a huge difference.
Good. How about just putting everything into a target date fund? What's your advice there? If that's all you're going to do, it's better than leave it in cash. There's sometimes the expenses can be high on the target date funds. Sometimes you have to look beneath the covers. What they hold, their asset allocation essentially might differ from what you would want it to be. Maybe going back to the question on, is your young 60s near retirement, 60% bonds appropriate? That may feel appropriate to somebody, but for somebody else, that may be way too conservative. So, you kind of have to look below the surface in the target date funds. And if you look at one company's target date funds versus another, they may have a different group of assets. If we are talking about in a retirement plan, there is, no tax consequence to changing your mind. If one thing about people, and this is a little bit of a different question, but, why shouldn't I just put it all in S&P 500 ETF or something like that? If it's in a taxable account, that's going to grow over time. You are never going to be able to sort of tax optimize. If you own the 500 different stocks within the S&P 500, some of them are up and some of them are down. And in any one year, you may be able to sell and take some losses to offset gains on gainers and that kind of thing. If you own just the ETF, you can't do that. So it's a little bit similar with a target date fund. You don't have as much flexibility, particularly if it's in a taxable account. But if that's all you're going to do,
can you tell us what?
Do it.
Well, I mean, I don't know if everyone knows what a target date fund and ETF are on the call.
So these are pretty common in like a retirement plan. A good use of them would be, let's say, in a 529 plan when you're saving for your child's education. And they're going to go to college in the year 2040, and you would just buy a target date fund. And if the child was, so that would make a child 5 years old, let's say, or something, in that area, it would be it would be on the aggressive side. It would be probably mostly in equities to start. But each year they automatically rebalance it, knowing that is your target date to basically take the money out, whether that's retirement or perhaps something like college or some use of the money. You're getting more and more conservative as you get closer and closer to that target date.
An ETF?
ETF, that's a good question. So I think most people probably know what a mutual fund is. And it is buying into a diversified pool of assets that is managed by somebody else. And there's active and there's passive management. Passive means basically it's an index fund. It follows an index. Active means it's somebody is making those decisions what to own, not just own, for example, what's in the S&P 500. Those only trade at the end of the business day. There's tax consequences to a mutual fund, which are that once a year at least, they have to pay out all of the capital gains, net of losses, and all of the income in the year. And if you own it in a taxable account, you are going to have to pay taxes on it. An exchange traded fund is a bit newer, but they've been around for, I don't know, at least 20 years. A similar concept in that you are buying into a pool of assets, so you are getting automatic diversification. And that can range from, again, small cap stocks, large cap stocks, mid cap, foreign, emerging markets, et cetera, et cetera. They can be specific to a sector like technology, or some of them are thematic like artificial intelligence. They are tradable during the day. So you have more control of when you're buying them. Even though I told you not to time the market, if you saw the market down 4% or in one day and you said, I want to buy in now, better than trying to sell and time the market, then you could do it during the day. And they are more tax efficient. You don't have those issues that you have with a mutual fund.
Okay.
So in other words, you would only pay capital gains or losses if you sold them. So you're in charge of that.
This is a good one. How do I determine which company and then which advisor in the company is the best fit for me?
Yeah. Talk to a few. I would start with get some recommendations, maybe from some friends. And I think, I tell a story. My husband had colon cancer several years ago, and he's fine. So this might ring true with you guys. And everybody said the surgeon is the most important thing. So we went out and we talked to 5 surgeons, and the 5th surgeon said, "You kidding me? You talked to 5 of us?" And I said, "Yup, and you're the guy." Done. Like, we just talking to people, we learned about different methods. Somebody was robotic, somebody else wasn't. Just different their background, their skills, how they go about things. So talking to different people really empowers you. I mean, information and understanding is power. So I would say there's plenty of, some of the larger companies are going to be good companies out there. There are fee-based advisors, which should be working to sort of have your best interests in mind. They sort of work alongside of you. I mean, there are going to be some people that are going to be much more financial planning based. And if that rings true with you and that's what's going to work for you, then that's great. There's some people that are going to be more investment based. The financial planning may be less about what actually is achieving that plan. They're more focused on the plan. And others, I personally am more investment based. That's my background. So it's going to be, it's just going to be a little bit of work. Here's the number one thing, and everybody could write this down. You can go to brokercheck.finra, FINRA.org, and type in their name and the state. I think that's all you need, and check their record. Because sometimes you will find that somebody has some marks on their record that they've made inappropriate investments for their clients, or done other things that I had somebody who came to me and said, "Oh, I've heard this great things. I'm going to go to this guy, whatever." And I looked him up, and he'd been banned from the industry for 2 years. That's the first thing you check.
That's a really great resource.
It's a very regulated industry. Unfortunately, there's some bad actors out there.
I think we skipped a question too. If
Yes.
you are getting started, what resources do you recommend to read or listen to in order to better educate yourself?
It's interesting. I get a little insulted by some of the stuff that is geared towards women. Honestly, I think some of it is a little dumbed down, and everything is put in terms of shopping or these kinds of things. And I personally get a little insulted by it. It might work for you guys. There are some things like Dow Janes is one as opposed to Dow Jones. One I just found recently that I actually really liked because it is not trying to sell you something, essentially. And it is on Investopedia. So Investopedia, like Wikipedia. And it was just something like, I'm forgetting the exact title of it, but it was like how to start buying stocks in the year 2025. And it was 7 steps and it was laid out sort of, here's the kinds of things to start thinking about and learning about. And I thought that would probably be a pretty good start. You can go on, Raymond James has some resources. I know Schwab does and Fidelity does and whatever, a lot of learning resources. I like the Investopedia because it's not trying to sell you anything.
Hey, what about should your partner and you all have all joint accounts?
Oh, this is a good question. I love this question. Not necessarily, particularly if one of you has a lot more assets than the other that you came to and I'm assuming this is a marriage, to the marriage with. And I hate to say it, but having a practice with a lot of women, I have counseled a lot of women through divorce. And, maybe some of those, if you go back to the 74% of divorcees and widows who found, financial surprises, I mean, one of the financial surprises may be, I had a house before we got married and we sold the house and bought a bigger house together and we put it in joint names. And 5, 10, whatever years later, we're getting divorced. And I kind of want the whatever it was more because I put in that and he just helped pay the mortgage along the way. It's a joint asset. He, assuming it's a he, is getting half. So those are some inheritances is another one. I would keep it in your name. If you are significantly different earners, it's going to be a little bit up to you. It's easier to put it together, but just be well aware that, it's kind of like, I'm sure nobody here is getting divorced, but except for 50% of us, right? So be careful with that. Be open and forthright from the start. It's so much easier. But how you title your assets matter. Another interesting thing is, this is new. If you do have your assets in a joint account, well, here's one particularly for the older people, but you never know what can happen. There's a lot of people who have, let's say, joint credit cards, or they think they do, but it's actually only in one person's name. The other person just has the credit card. And then the person whose name is in dies, and all the credit cards are like cut off. And you have no liquidity. You're just trying to pay the bills and that kind of thing. So how you title your accounts does matter. So one thing I was going to say is, even if you have a joint account, you can put it in transfer on death. And that means it's not going to get stuck in probate and waiting for death certificates and that kind of thing. Normally, even if it's a joint account, both your names are on it, it shouldn't matter, but this can make it even easier. And that's kind of getting into the weeds, but.
Very good. I don't see any other questions at the moment. Does anybody have anything else? Speak now, type now, raise your hand.
One last question.
Sure.
So, often when we join our practices, we have investment vehicles, which are either big companies like Transamerica and Schwab, and they always offer services for investments. Is there a benefit to having that big company with their opportunities for investment, or are smaller firms able to work more closely with you and do a better job with your money?
I think a little bit is going to depend on the financial advisor. I do find that some of the firms tend to sort of push product. Again, they're kind of trying to sell you something. It's always good to ask questions about, how do you make money, you, the financial advisor across the desk from me? Because sometimes there are products where they're going to make more money than another one, and maybe be a little bit have a conflict of interest about what they're really, suggesting to you. So understanding that is a really valid question. I'm always amazed at how many people come, if they're referred to me or something, and they don't even know what kind of fees that they're paying. I think that most of the smaller firms, I mean, Raymond James would be sort of like a mid-sized firm. And what I like is we have access to Schwab products, Fidelity products, maybe it's TransUnion products, or we have products from a lot of different, a lot available to us. And we're more, the people that work the way I work with Raymond James are independent. So less conflicted about wanting to just, only having Schwab products if you're a Schwab, or only having Fidelity products if you're a Fidelity, or that kind of thing. It's basically an open architecture platform. Some of the very smaller firms, I've worked at some smaller firms, can also, can get quite an assortment of availability of different things. And that could be something like, let's say, a securities-based line of credit to give you liquidity instead of a home equity loan, or, there's all different kinds of things out there. High interest sort of savings type of options and that kind of thing. I think in this day and age that you can probably find what you need, whether it's small or large, and it's going to depend a little bit more for you. I tend to be a person who prefers the smaller, the more independent. You can be a little bit more creative in a good way.
Last call. Anything else? I don't see anything in the chat just yet. Going once? Going twice?
Well, I hope it was helpful. I thank you all for listening, and especially the people where it's late or people who rushed right out of work.
Yes.
I hope it's helpful.
It was extremely helpful, and we had a couple of different folks all writing in on the Q&A or chat too, really thanking you and for such an engaging and very insightful session. I'm
thank
certainly
you.
very appreciative.
Yeah, go get them, I guess.
And maybe that last website or right, broker
Sure.
check, right? If we
There was
can
broker
maybe, right.
.finra,
Maybe.
which is the regulatory body, FINRA.org. And then there was the Investopedia. Was that one also?
Okay.
People might want to write down.
So maybe we can post that maybe on the link with the webinar so that people can have that resource, because those seem like really great resources.
I'm not sure if you're going to post the slides, but my email and phone number are on there. If you want to reach out to me, if you want a copy of the slides, if you have a question, feel free to reach out.
Again, thank you so much for your time tonight.
Yes,
You're welcome.
thank you. Wonderful.
Thank you for inviting me.